Welcome to Remarkable Retail Podcast, Season 11, Episode 10. I'm Michael LeBlanc.
And I'm Steve Dennis.
We have an action-packed episode for the people. Our guest back on the podcast is Lauren Sherman. Lauren is the preeminent fashion journalist of her generation, offering incisive reportage. Yes, they say reportage on the Puck site on all aspects of the industry and its biggest players. Formerly top executive of business fashion. Last on with us talking about her recent book, Selling Sexy, all about Victoria's Secret. But wait, that's not all. We are joined by a guest co-host hailing from London, England. You've seen him on stages in Vegas, Chicago, and soon in Abu Dhabi, and heard his insightful insights in that funny accent of his. Ben Miller, Vice President, Original Content and Strategy, Shoptalk, Grocery Shop, and soon Luxe. Welcome, Ben.
Oh, Michael, Steve, thank you very much. It's absolute pleasure to be here. Very big fan of the pod. I think you've covered some really important topics, and there's been a really important voice for the industry. So it's having known you for a number of years, the first time to be invited on, which I'm honored to be here. So thanks very much. Looking forward to the conversation.
Well, the honor is certainly all ours. But for let's not assume everybody knows who you are. Tell us a little bit about who you are and what you do for a living.
In fact, I have the privilege to serve as the Vice President of what we call Original Content across the global Shoptalk group. So I think hopefully the majority of your listeners by now will know who Shoptalk is. We see ourselves as the primary, the most important retail shows in the world. We cover retail innovation, disruption, and particularly digital transformation. So very heavy lean towards digital transformation across our shows in the US, in Europe, and as you say, opening up in Abu Dhabi for Shoptalk Luxe. And my role is to work across the whole portfolio. My background is in research and in retail. So I started on the shop floor in a UK grocery supermarket and worked in head office and investor relations and finance roles. And I worked in consultancy, particularly helping CPGs to sell into retailers. And I now work on insights, trying to understand what goes on in this fantastic and ever-changing industry that we work in, and try and make sure that the content that we put on the platforms and our shows highlight the very best research, the very latest thinking, and the very latest trends in the industry around the world.
Well, when Steve and I were considering who would be a great co-host, your breadth of view, you have to take in so much. Your name came right to the top of the list. So once again, thanks for joining us. And in the news this week, as we kind of roll into the episode, we're going to be talking about Amazon results, GLP-1 drugs, maybe aren't just shrinking waistlines. This week in AI, retail earnings, and more. And you'll want to stay tuned after our discussion with Lauren. And we're all going to talk about what we found most remarkable this week and what's on our radar screen for the weeks ahead. All right, let's jump in. Steve, let's talk about, I guess the biggest news of the week is Amazon earnings. They're just such an important player. Talk about what your observations were.
Well, a lot of people will know last week was a huge week for earnings. The so-called Mag 7 pretty much all reported. But in the retail world, Amazon was the most interesting. One thing I'll say, because I'm not going to go super deep on this, I'd really encourage people to go take a look at the Amazon earnings announcement and or check out the earnings transcript, because there's just a lot of details that they go into, which are really fascinating about their tech investments, their innovations, all that kind of stuff. But overall, really another great quarter from them. One thing which is not really retail centric was that Amazon Web Services, which folks will know is a huge profit contributor to Amazon, had their growth kind of re-accelerate. They'd been lagging a bit. They have quite a large lead on everybody else. So, trying to keep that growth going, I think, was an important change. But getting into the more retail part, my standard caveat, as longtime listeners will know, is Amazon's great at giving a lot of top-line information, but not that really gets to profitability because it's buried in some segment reporting. So their North American segment, for example, includes all the retail stuff, but it also includes ads. It also includes Prime. It also includes the media stuff. So anyway, at a top-line level, really strong. First-party sales up 10%. So, we're generally seeing an industry that's growing 4 to 5%. Third party, which is actually the majority of their e-commerce, was up 11%. So third party, so the marketplace fulfilled by Amazon stuff, continues to grow faster than their own business. Physical retail, which is really at this point just grocery and mostly Whole Foods, up 7%. So that's definitely better than the major grocery players, perhaps with the exception of Walmart. And one of the more interesting things, which gets to profitability, is their shipping costs. So all the fulfillment infrastructures only growing at 6%. So sales growing faster than fulfillment, which of course is a big part of their margin structure. So they're getting quite a lot of leverage there. So, but of course, as has been the case, I think for probably, 3 years now, star of the show, the ad business up 24%, extremely high margin. So all around, and I think we've got another story we'll talk about in Amazon in just a few minutes, but pretty strong. And it just really continues this narrative of the big getting bigger. I expect we'll see Walmart when they report in a few weeks and Costco have above average sales. So the big three, at least in North America, continue to really put up big numbers.
Well, and did you say 24% in their ads business? I mean, it's not like their ads business is a small startup component of Amazon. I mean, that's 24% on a massive business, right? So
yeah,
really,
and probably 70-80% gross margin. We don't really know, but massive contributor to profits, and probably at this point a bigger profit contributor than AWS. But they're all sort of tied together. It's not quite can't really think of it as a standalone business.
Now, outside of core retail, kind of a mixed bag, as you were telling me. You've got some consumer we've got some consumer slowdown in Chipotle and Starbucks. Ben, you pay a lot of attention to the CPG side because of the the grocery shop connection, and you see both sides of it. Talk about what you're seeing, and then you've got a particular retailer you wanted to comment on.
Yeah, I think it's a really interesting time for the CPGs. It's almost an entirely predictable set of results and not terribly positive. So we've been seeing this story now for the large CPGs for a while now of limited top line growth, of kind of lowering outlook, and we had a little bit of this in the last quarter. But when you dig in, the majority of major CPGs are relying on price rather than volume to drive the sales. So it's coming from inflation, and we've seen inflation figures in the US in the last week that food inflation continues to grow. And all of that is a huge topic, but one of the things it continues to drive as the major branded CPGs put more through price to try and growth, they're not driving the efficiencies. It's hard to drive the profit, and it creates increased price differential to the private labels. And we continue to see shift to private label products within categories and shift to private label-based retailers on a macro scale. So I think we see more of that trend. We're continuing to see not enough attention given to digital. But on where we are seeing some numbers, I think digital is delivering the majority of growth for a number of the CPGs, and we need to put more shoulders behind it. But again, huge category. I think the one, as well as the kind of the food CPGs, I look at the consumer products in general, and I just want to call out Estee Lauder because we've got this great interview coming up with Lauren Sherman, and Estee Lauder in the middle of their turnaround. But one of the things that really chimed to me reading their results is kind of building on some of the comments that we'll hear from Lauren, is that they were increasingly positive about their Chinese business. So, followers of the luxury market will know that China, a huge growth engine, really dipped. We're starting to see some green shoots. They're very early. They're very tentative. But Estee Lauder talked about their Chinese business sales being up 9%. So it's the latest bit of evidence that we might be past the trough in the decline in Chinese luxury, which is, I think, really encouraging for lots of brands and retailers as we go through the next coming quarters.
Steve, back to you on one thing. You mentioned the Mag 7, which is this, this impact of these AI-driven organizations really, just sucking the oxygen out of the growth engine. Any further comment on that in the context of what we're talking about today?
Well, two things I'd add, just kind of big picture. One is, the amount of investment, $100 billion plus CapEx from Meta, from Alphabet, from Amazon. So, this isn't an investment podcast, but if you just look at the returns, I think it's now the top 10 companies account for 80% of the stock market gains this year. So to Ben's point, if you look at just about everybody else, including some of the major industrial CPG players, you name it, not great performance, both in the stock market and objectively kind of in their results. So, yeah, I think that's going to be a big story for the foreseeable future. The second thing I was going to mention, which has nothing really to do with technology, is kind of an early warning sign perhaps for the consumer, is we got earnings from Chipotle, from Starbucks, Shake Shack, and all three of them were on the disappointing side, and all three of them pointed in particular to weakness from younger customers, which generally speaking is going to line up with lower income customers. So I think there's more evidence of this squeeze that is going on, at least with the not so wealthy consumer, which we get into with Lauren in a bit. So I don't want to tease that too heavily, but we will come back to that.
All right, well, let's talk about the macro front. So, we've got President Trump in China, who seems to be negotiating, not in China, but talking to the Chinese leadership, seemed to be negotiating his way out of the box he put himself in. Steve, take us through what the impact could be. It's very, very important that China and America have some kind of trading relationship. But what else did you talk about that, and what else did you note in the broader picture?
Yeah, just in the interest of time, I'll keep this pretty high level because things are, also constantly changing. But there appear, in one way of looking at it, there appears to be some progress on tariffs in that the U.S. and China did make some agreements related to fentanyl and related to resuming soybean shipments and these kinds of things, a 10% reduction in tariffs. Now, at the risk of sounding cynical, to the extent this actually sticks, we as the U.S. are not in a better place than we were before this all started. So causing all this disruption, all this impact on various companies and the economy to basically get back to where we were doesn't seem to me to be a victory. But the reality was, I think the reality is China's got more over the U.S. than the U.S. has over China. So this might be a decent outcome for all concerned, but we'll see. The other part, recent listeners will know that we joked around about how many times we recorded a TikTok deal story and then edited it out of the podcast. But then we decided to include it. And of course, now several weeks have passed and there's still no TikTok deal. So anyway, TBD if anything comes of that. The other kind of quick things, and I'd love to get some of Ben's comments on this as well, particularly from the across the pond perspective, a lot of layoff announcements last week. Amazon, UPS, a bunch of other companies with very huge announcements about reductions. One of the things that I saw several commentators point out, though, is that 70 to 80% of the job growth comes from small and medium-sized businesses. So these very well-known companies with $5,000, $10,000, $15,000 layoffs get a lot of news, but they don't necessarily move the employment picture very much. It's really what's going on with the small and medium-sized business, and we don't have a lot of visibility to that, at least at this point. And then the other thing, just kind of in the bigger picture macro, was the Federal Reserve, as expected, cut interest rates by 25 basis points, 0.25%. But the thing that really got the news was they basically signaled, maybe there's not going to be any more cuts for a while. And the market had been thinking that the December rate cut and perhaps another January rate cut were in the cards. So that caused a certain amount of turmoil. Chair Powell made some comments about basically the job picture seems to be weakening. Inflation doesn't seem to be coming down, which gets to the stagflation scenario we've talked about a few times. So that just kind of put a monkey wrench, I think, in the narrative that had developed over the past several weeks. And of course, we still have the government shutdown going on. We don't have as much data. So it's just more uncertainty, I think, when we were maybe on a path that looked like we might have a bit more uncertainty, at least from the interest rate perspective.
Ben, every time I read these big layoffs from big companies, whether it's them, they don't really comment on this, or other folks that go, oh, that's AI. AI is taking those jobs, because everything's in a context of AI some days. But A, what are your thoughts on the big player movements? And B, what's going on your side of the world? Are you seeing similar trends?
Yeah, I think there's three things I could say. One is whenever there is big layoff announcements. And this week we've seen some significant numbers, and those numbers turn into real people who, suddenly your LinkedIn is flooded with people who walked into the office and found out that they didn't have a job that day, and it's coming to holiday season. So I guess first there is that compassionate, best of luck to everybody who's coming into some difficult times, because there's that human angle to it. I think there's a secondary point, which is understanding that we are going into a situation where organization structures will be being redesigned to live alongside AI. So, I mean, already consultants are talking about agentic transformation as like the next level of digital transformation, i.e., how do you reconfigure your business to work alongside tools, processes, and agents, AI. So the average IQ of an AI agent is thought to currently be around 130, 140. With 100 being the average of a human. And there's projections of where that's going to go over the next year, which range anything from 180 to 300. Yeah. So there is this knowledge, this capacity, this ability that companies will be bringing into their organizations, and it will change structures, and it will change how organizations run to have both kind of human talent, human capital, and artificial capital sitting together. So I think we can expect to see more changes of this as people evolve their organizations to make that work.
Wow. IQ's in the level of 300. You're getting a Steve Dennis IQ there now once you start talking about that. My goodness.
I was going to say Ben Miller, but okay. We have our fan club meeting after we finish the recording.
All right. So since we're talking about AI, let's segue into talking more about AI, so to speak, kind of this week in ChatGPT. Ben, what have you... You must be watching it so closely. What did you observe this week? What caught your eye?
Yeah, it's something that I'm spending a lot of time on. I think because it's fascinating. What's happening now, and has been happening since September the 29th, since OpenAI announced the ACP, the Agentic Commerce Protocol. We are watching OpenAI build a commerce platform of scale in front of our eyes. And every week there is a new announcement, there's a new bit of news. You guys talked about Atlas last week. This week it's PayPal, talking that they're going to adopt the protocol so you can use PayPal to pay within ChatGPT. It's not a huge announcement of its own right. PayPal got a nice little stock price boost off it for a day, and then that drop back off again. But it's how it's seen in the wider picture, and that wider picture is this move, this potential for commerce to take place within an answer engine. And I think one of the things we're seeing is the tech stack that is being developed, the way this ACP, the Agentic Commerce Protocol, works, it's happening within the agent. Whereas traditional e-commerce, multi-stages with lots of different parts, lots of different parts of the tech stack and elements that need to feed in. ChatGPT are building something, OpenAI are building something just themselves, which is harder to influence. So I think following this, tracking this is, for me, the number one thing that anybody working in digital commerce should be doing right now. Because, and I know you guys did a great episode just a couple of weeks ago with Scott Wingo, who knows considerably more about this than I do. So I'd absolutely recommend people to go and listen to Scott. He's really interesting on this. But I think to put it into context, just in the last week, and it was actually as part of the PayPal announcement, we learned that there are 800 million users a week of ChatGPT. So so just 1 in 10 of the world's population. So look, Steve, as you would say, that's not nothing. So there is a platform of scale that is being built into a commerce platform in front of our very eyes, and we've all got to pay huge attention to it.
Steve, you've often said, just thoughts on this, you've often said better be the toll booth than the road. Are we retailers up against this again?
Did I say that? That's really clever. I like that. I think I stole that from somebody, to be fair. But, I've talked a lot about the speed of disruption and how fast it's accelerating. And even when I was working on my last book, where I've got the speed of disruption in the subtitle, 2 years ago, when I was really in the heart of writing that, this wasn't even on my radar screen. And, some of that may speak to the quality of my research, but I think more broadly, it just speaks to how things are coming almost out of left field. I'm sure there's, MIT scientists or whatever that are way ahead of this. But when you think about your typical retail operator, how many folks are really paying attention to this? And then what it takes to really understand it, particularly, and Ben does a great job of pointing out, there's some really fundamental shifts. It's not just an evolution of the way we've thought about search or the way we've thought about commerce. It's really a major shift. And who knows what's going to come next? There's going to be an announcement probably from Anthropic or whatever next week by the time people listen to this. So yeah, it's just mind boggling. And I think it really causes us to be greater students, to open the aperture on what we want to consider. And which is hard when, we've talked about this before, when you're trying to run a business, when you're trying to deal with the day-to-day stuff, to create enough space and time and focus to consider what these new things might mean for you and experiment and learn.
All right, let's now go into our great interview with Lauren Sherman. We'll be back right after the interview. We'll talk a little bit more about Shoptalk Luxe. I want to hear a little bit more from that angle from Ben, and then we'll talk about things you're going to want to talk about that happened this week and looking forward around the corner. So let's hear our interview with Lauren. Lauren, welcome back to Remarkable Retail Podcast. How are you?
I'm well. How are you all? Thanks for having me.
We are fabulous now that we have you on the microphone yet again. Last time we chatted with you, it was about your great book, Selling Sexy. Such a great conversation. We had it in 2 parts, and we're thrilled to have you back and go deeper and longer in the category. So where are we finding you today?
I'm in Los Angeles, where I am based for a couple of weeks. I'm going to New York next week, actually. It's always moving. But yeah, we live in LA, which is fun.
Let's not assume that our listeners know you, though many will, or that they heard you on the last episode. So tell us about who you are and the work you do and your journey to get there.
I am a fashion correspondent at Puck. I cover the fashion industry. I write our daily email line sheet, which anyone in retail knows what one of those are. And I've been writing about fashion and luxury and the machinations and the changes and the transformation of the industry for the past 20 years. I worked at Business of Fashion for a long time, and I got my start reporting at Forbes.
There's so much to talk about, I think, in some respects, and maybe I'm biased because of my time in the luxury and fashion world, but it does seem like it's one of the most dynamic parts of retail, and it's probably the one that is the most global because so many brands are, both retail and vendor brands, are in lots of countries, which is not always the case with some of the brands we talk about on the pod. And it's been a pretty interesting year or so. So I thought maybe we could start kind of big picture. And I'm curious what you think have been some of the key dynamics over the last few years. And then I guess particularly as we talk about some of the struggles, what's really driving that and what's really determining the winners and the losers in this market?
Yeah, the crux of my coverage over the past 20 years has been about the luxury industry in particular and the consolidation of that industry, mostly because it is a super global industry. And also, I sort of started out just as it was getting big and becoming, instead of an organization of sort of mom and pop shops, a real force driving economies across the globe. So while I always say I cover everything from Target to Hermès, it has been a bigger focus for me, the sort of high end. And also the other point is as across the world, but especially in the Western world, we're seeing a real hollowing out of the middle. So everything, the rich getting richer, the poor getting poorer, the most expensive stuff getting more expensive, the cheaper stuff getting cheaper. I've tended to focus on the high end and the low end. But I would say that the last couple of years have been in particular super interesting at the top of the market because of the post-COVID or, actually like end of COVID boom that a lot of luxury brands experienced. And it felt like that industry, there was just nowhere to go but up. And in the last year or so, and, we foreshadowed this previous, but I would say all the different political unrest combined with a real slowdown in spending in China that I don't believe many of the Western brands ever anticipated would happen, has really changed the dynamics of the business and sort of created a reset where for a while there, it felt like luxury brands could dole out product as if they were fast fashion and the consumer would just buy whatever they were selling. And now the consumer, is discerning, they're really educated, and they will keep buying stuff. You look at a company like Hermès, where they are still seeing growth in China. It's definitely slowed, but they have been successful across the board. Whereas a bigger company like LVMH, which is, I'd say, more masstige at this point, they've had real challenges in that market. And so it was these untouchables suddenly became touchable. And so it's been a really interesting past year, especially. It's definitely the biggest crisis I've seen the luxury industry undergo. Whereas with, more traditional retail and mass market, there are always ups and downs with that. It's so cyclical. But with luxury, this is the first time I have been like, oh, okay, maybe there isn't infinite growth in this space.
Right.
We'll be right back after these messages. Promotional support for the Remarkable Retail podcast is provided by Crave Retail. What's retail's biggest blind spot? The fitting room. A shopper wants to buy, but can't get the help they need. That's why global brands partner with Crave Retail, the market leader in smart fitting rooms. Crave connects that moment to your business, giving shoppers a voice, associates real-time alerts, and teams the data to buy smarter. The result? Higher conversion, better decisions, a seamless experience. Learn how fast you can elevate your fitting rooms at craveretail.com. If the world has changed so very, very much, why have so many organizations changed so little? As the pace of disruption accelerates, leaders need the courage and the insight to aim higher in the value they deliver, move faster than they ever have before, and take the bold action to leap ahead of the competition. With Leaders Leap, Transforming Your Company at the Speed of Disruption, Steve's latest breakthrough bestseller, you'll discover why so many companies fall into the trap of the timid transformation. More than anything, you'll learn about the essential mind leaps leaders need to make to win the future. Leaders Leap is available just about everywhere books are sold, as well as on Audible and as an ebook on Kindle for just $9.99.
How much one thing that I observed way back when I was still at Neiman Marcus was we were driving, and we certainly weren't alone, a lot of our growth through price increases.
Yeah.
And we were tending to do much better with, I'll just say broadly, kind of the top 1% customer, the true luxury customer, as opposed to the more aspirational or accessible luxury customer. That seems to, I think part of what you're saying about Hermès, that seems to be part of the case. But I think the other big shift is just the broader competitive landscape. We have, as you well know, many of the vendors have greatly increased their direct-to-consumer investment. And by that, I mean both online as well as their own stores. It seems like it's just an explosion of vendor stores over the last decade or so. We have department stores getting into all sorts of trouble. In some cases, the hollowing out of the middle. In some cases, just shifting trends. In some cases, more financial reasons. Then there's My Teresa, Net-a-Porter, a lot of the online players emerging. I mean, how much of what you see is really kind of this distribution shift versus consumer trends, or maybe just these brands misreading how high was up?
So much of it is about distribution and pricing. That none of that it's changed, but the impact that it can have is stronger than ever. I would say that during COVID, there was a very big boom that was driven by entry price, because there were, especially in the US, there were a lot of consumers who still had full-time jobs and were also getting stimulus checks. Where did they take those stimulus checks? To sort of the entry-level designer goods. Let's buy some $800 Dior Nike sneakers. Let's buy a Louis Vuitton wallet, that sort of thing. And so the luxury brand saw a huge boom 22, 23 because of the fact that a lot of people had extra income that they didn't really have anything to do. Like, they didn't know what to do with it because they couldn't travel.
No travel, yeah.
So, but in the last year or two, I'd say the focus for the luxury brands has been on the top 1% or even tighter than that in terms of their consumer, because that's the person that is still spending at a regular pace. So you definitely we saw tons of price increases. I think some of the brands are pulling back a bit now because they weren't able to justify it in the way an Hermès can. But we saw tons of price increases. And then, yes, of course, the last decade of growth in the luxury industry, a lot of that has to do with the changes in the distribution model, because suddenly, Louis Vuitton and Chanel, they were never wholesaling. It was always consignment in the department stores. And then also, it's all direct to consumer. But now Prada Group is a great example of this. I think 90% of their business, at least at one point, it may be a little lower now, 90% of their business is direct to consumer. That is a huge change.
Wow.
And so obviously the margins on direct to consumer are much higher. That allows for bigger price increases. The more stores you open, the more distribution you have. And you also see the dynamics between the big players and the department stores changing, where they may not feel like they need to be in a department store in a tertiary city if they have their own boutique. And you look at companies like Gucci and Louis Vuitton and Hermès, they opened a lot of stores in tertiary cities in the past 5 years. And so, yes, those two factors have been had a tremendous impact on the industry. I think the question now is, how far can they go? How many stores do you actually need? How much are people willing to buy? And that is a big question, especially as I think the China factor is so big, because the growing middle class, every year, new billionaires are minted. If you look at the Capgemini Bain luxury list and you look at the number of high net worth individuals in a country, China would just climb every single year. But the reality is that all stopped. And also the Chinese consumer got hip to the fact there are so many cohorts in China. It's hard to just say the Chinese consumer, but it's a very discerning customer overall. And also they're making their own culture now. I have written about this several times, but I think if you look at the top 10 grossing movies from the past year, 1 or 2 of them are from China. And those are movies that were not distributed anywhere else. And so it's coming for Hollywood. And I think fashion is just next. So it's it's a confluence of factors, but the luxury industry and the desire for luxury goods is not going away. However, I do think the role that those products play in a consumer's life, where they have been at the center of pop culture for the last 15 years or so, maybe is changing and is going to take a backseat to other things.
Such an interesting discussion. Can I pull on one thread quickly? This the Chinese consumer. Are you or the retailers you talk to? Are you guys tracking the absence of the Chinese shopper in North America? I mean, it's like a $20 billion, $22 billion hole in net incremental spending. Now, some brands would get that value themselves directly in China, but there's an absence in the market in North America. Yeah,
for sure. I think one of the things that a lot of the brands are kind of focusing on is the fact that they are still seeing a lot of growth in the US with the local customer, but certainly, and this has been a huge issue in Europe, the tourism decrease. And you're seeing, I'm sure Europe is seeing some US customers going there because the prices are better, that sort of thing. But generally, the focus has really had to be on the local customer. And you also see this in the dynamic between Japan and China. So Japan was up for a good while because because of their currency and also the tourism coming from China. That was like the one place the Chinese were going. And now you're seeing the slowdown in that. So, I think one thing that's important to remember with these companies is that they, as much as luxury says they take a long-term view, and I do believe that they do that more than, say, a mall retailer who is really, truly everything they do is for the shareholders. Whereas in Europe, these luxury brands, a lot of the control is over a family ownership, even if they are publicly floated. But I think the reality of it is, yes, they take a long-term view, but they also take the easy wins, like how to fix this Chinese problem. I think in the Louis Vuitton earnings call, the CFO, Cecile, she said a couple things that I thought were really interesting about how much they are focused in particular on retail innovation. So yes, product and product innovation is very important. And you see them sort of relying on old tricks, like they keep relaunching new Takashi Murakami collaborations because they know the consumer has an appetite for that. But the thing she said, about 6 months ago, Louis Vuitton opened this big new store in Shanghai that's a giant ship.
Yeah,
it's
right.
really wild looking.
Yeah.
And, it feels so goofy to me. Why would anyone want that? And the reality of it is, she said, people are into it. It's doing super, super well. They also mentioned at Tiffany, when you renovate a store, the store performs better. So I think there are little things they're doing. I think a lot of it has to do with tweaking product and tweaking the retail experience and being willing to invest in that. But on the other hand, they're going to take the wins where they can. And so tourism in China down, sure. Are they really going to be able to do anything about that? Let's just focus on the fact that the local customer in the US still wants to buy.
Well, it's a good segue to talk about, or shift gears a little bit and talk about local American retailers, Saks Fifth Avenue, Neiman's merger you've written. We've talked about it extensively as well. Any broader lessons that you're taking away from what's happening in that organization? I mean, they left with a flourish out of Canada, so they're gone here, so we don't get to see them on a day-to-day basis. Any lessons or anything we should be paying attention to?
Yeah, look, I get this question every 6 months about all different retailers. Last night, a jewelry designer texted me and said, is Essence, which is obviously a local hero, Essence, the online retailer, is that going to survive? And, my answer for all this stuff is, anytime a brand calls me and says, should I engage with these people? Should I sell to these people? And it's every retailer is challenged in a certain way. My answer is always, look, there is a real value in being a part of the wholesale ecosystem. I think as direct to consumer becomes easier to facilitate, the wholesale channel has become more of a marketing opportunity. But the reality of it is, you have to budget into your plan that one of these places may not exist next year. I can't predict the future, but you look at Matches Fashion is a great example of that. I had a good friend who lost a lot of money on that, and I know many brands that did. But there was something going around recently of a list of all the brands that Essence owes money to, and they owe many like $500,000, $300,000, that sort of thing. And you sort of just have to. That is the reality of where we live now. Do I think that there is a way out of that and a potential way to do a multi-brand store with, whether that's a dropship or consignment, which is a new thing, or whether that is traditional wholesale? Absolutely. I think you see this especially at the more independent retailers that only have one or two shops. Another great example is the Webster recently sold to Fraser's Group in the UK, which also owns Matches Fashion. Look, like, they're still going to be able to operate. Is that an ideal owner? I would argue that it's not. But I think the issue with a lot of these companies is they are overstored. There is not a need for as many stores. As much as I would love to go shopping on the weekend, I do not have time. We filled up our lives with other things. And so I think it's just something, the model, no one has figured out how. Everybody wants stores. Everybody wants a cool store to be able to walk into and go to on a Saturday once a month. But it used to be that people would do that once a week, and now they do it once every 6 months or what have you. And so I think there's a way forward, but there needs to be a little bit more innovation in the model and a little bit more, I think, being a little more realistic. Like when you I see this a lot with the independent retailers. They'll get an outside investor and then they had 2 stores that were really profitable and did really well. Then they open 7 more and they're not. And I remember when Barney's went bankrupt, I had a lot of financial information because they had been trying to raise money. And so I got to see the pitch deck and I saw a lot of their sales. And that New York main Barney store was extremely profitable. This is 10 years ago now, but so was LA. After that,
yeah, different picture.
Nothing. So I think you just we gotta reset expectations of what the point of these stores is.
Maybe just shift gears a little bit to some of these more disruptive models, perhaps. I'm interested in your quick take on resale, as well as rental, and the degree to which you see these as both interesting growth opportunities, because brands like The Real have had, and Nuuly and others have had an impact, but are still relatively small when we think about the whole luxury fashion space. But they're also perhaps another thing that is taking away from department stores, taking away from some of the other players in the market. How do you see this evolving?
Oh, for sure. I think that the impact of resale in particular, but also rental to an extent, because that is, as Jen Hyman would say, is a short form of resale, but or resale is a long form of rental. But I think pre-COVID, it was very clear that this was becoming a thing, and then COVID sort of stagnated all the development and all the advancement in the industry, and then it picked back up again in the last couple of years. My colleague Sarah Shapiro just did something on sort of this psychological recession that we're experiencing and why rental is seeing a bump and resale as well. I think I'm less educated on the rental market, and I think that is just limited. There is just a limited group of consumers who want to rent clothing in that way, and also especially who want to rent clothing at all, and also especially because clothing is so affordable on the resale market, and then also obviously on the lower end of the market, that it feels almost rental. There's only particular use cases for it. But with resale, look, I mean, I think that is now a part of the customer journey. You want a black dress for a black tie event. You're going to go to the department stores. You're going to look online. You're going to go to the specialty retailers. And you are also going to check The Real or Vestiaire Collective, that type of thing, if you're after something in particular. And I do think it has changed consumer behavior in a way that many people don't realize, because now not only are people buying, in some cases, like the way it's benefited the luxury brands in particular is that a consumer will say, oh, I'll buy this Gucci sweater because I'll be able to resell it and get some value out of it if I don't want it in a couple of years. But on the other hand, I would say for more classic items from these brands, like a Louis Vuitton Neverfull, for instance, got really cool on the secondhand market. There are certain people that are always going to want to buy it fresh. There are other people who are maybe going to say, actually, why would I spend that on a Neverfull when I can get it on the Real for a quarter of the price? I think that will all calibrate, and generally the resale market has benefited the luxury market. Balenciaga motorcycle bag is a great example. That's been a huge success, the kind of refresh of that for carrying on Balenciaga, but it's also a huge thing on the secondhand market. So I think, but I do think that overall, even if it's benefited them, the retailers, the brands, everyone has underestimated how important the secondhand market is to the consumer now, and probably should have kind of gotten a little more in on it if they could, but it might be a little too late.
Super interesting, thinking of it or conceptualizing it as part of the overall buying journey now for just the kind of for every shopper. That's super interesting. So I think the three of us could probably all agree that social media could be big someday. So
I'm optimistic.
If you're optimistic, Lauren, what do you see the future for social media and the luxury category? I mean, my social media is just filled with these crazy AI generated videos now. I don't know what's real anymore. Talking about real. But how do you see it both inside and outside the fashion and beauty world? And where do you see the future? What are people talking about?
Well, look, this stuff changes so drastically, so quickly. And with AI, it's going to be even faster, that it's hard to make predictions or hard to say, this is what brands should be using social media for. This is how it's changing consumer behavior, because it's just every single week it's something new. But I would say the fundamental shift is consumers just are much closer to these brands than they were previously. They have access to these brands in a way that they never did before. And in some ways that's really good. In some ways that makes the brands less special. So I think you need to understand, accept that this is a part of the landscape, and how do you engage? I think the way Dior has engaged on social media since Jonathan Anderson arrived, and he is he's a really savvy marketer. I think the real challenge is I wrote this the other day. Once you let something into the world, it's no longer yours. And so these brands are so used to being able to control their message, and it's just going to be much harder to do that as things like AI generated videos create things that you can't get copy approval on those. So,
well, there's so much going on. And I know we're coming up against our time. I'm wondering if there are one or two things that we haven't talked about that might be on your radar screen that you think will be super important for luxury's future, or just, I guess, interesting, some maybe takeaway lessons for our audience. Anything or a couple things come to mind?
Yeah, I think one thing I've been writing about a lot recently, because I'm here in Los Angeles right now, is the relationship between the luxury world and the entertainment world. And the past couple of years, we've seen like an extreme proliferation of celebrity fronted advertising campaigns and a giant investment in the red carpet, because of the fact that we live in such a fragmented media culture. And what else is there but A-list celebrities? That's the only thing that sort of connects all of us. But I think what has happened, and which happens often, is that they've become a little too over-reliant on that market. It's been great for Hollywood because, as movies make less and less money, actors need other income revenue streams, and agents need them too. So it's been great for the entertainment industry. But I think that there is a question of whether we've reached an oversaturation and how effective those things are. The most amazing thing about the last 15 years is that this is all very measurable now. And sometimes measurability takes away the magic and makes things less special or less long lasting in terms of impact. But the reality of it is, like, if you don't see a return, that. And so I think right now the luxury brands are really throwing a lot at Hollywood, and I'm curious to see how long that lasts.
Very interesting. Well, Lauren, thanks again for joining us a second time and being so generous with your time and your insights. I would encourage our audience members that aren't checking out Lauren's work, as well as her great colleagues. You mentioned Sarah Shapiro. I love reading your stuff. I love listening to the Fashion People podcast. So there's lots from Lauren and her colleagues at Puck. I hope folks will check that out. And Lauren, thanks again for joining Michael and myself on the Remarkable Retail podcast.
Thank you for having me.
All right, we are back. Ben, we've kind of teased this Luxe. Not everyone might not know about it. It's a new property in Abu Dhabi. And Steve, you're going to be there as well. So Ben, tell us all about what Luxe is and what you're thinking about it.
Yeah, thanks. And really topical after that great conversation with Lawrence. So interesting to listen to. Look, we've got two really exciting things coming up in the first quarter of next year. At the end of March, we've got our 10th anniversary of Shoptalk. So Shoptalk will be 10 years old, coming of age. So we'll be celebrating that in Las Vegas. So Shoptalk Spring in Vegas. We're doing some new and what I hope will be really engaging and interesting and timely things that we'll be bringing and launching at that show. So that's coming up in Vegas in March. But before that, we are launching a brand new show, which we're calling Shoptalk Luxe. It's dedicated to luxury and premium retail. And really, if you think back 10 years when we launched Shoptalk because the industry was changing, the world was changing. There was incredible digital transformation happening in retail, and many incumbent organizations weren't keeping up. It was the time of unicorns, and VC money was flying in, and D2C. But we were learning about e-commerce and learning. Those happy days. We were kind of learning and scaling. But it was an industry being disrupted, and we needed to create a forum for people to exchange and learn and find partners that they could move forward with. And luxury, after kind of that post-pandemic boom, has had a couple of more difficult years. We touched on China, lots of reasons between that. Fundamentally, we've got a changing consumer. We've got an industry that hasn't embraced digital transformation to the fullest extent in the widest possible way, and is being buffeted by external and internal headwinds. And so we can see the parallels to when Shoptalk launched in 2016. So to do that, we are going to get everyone together in Abu Dhabi, in the beautiful Mandarin Oriental property right on the Gulf Shore, to create an elevated experience where we can bring the luxury community and the premium retail community together and do all the things that we used to with Shoptalk. There'll be some great content, there's meetings, there's vendor discovery, but really it's about learning, okay, how do we take the industry forward to meet the needs of future consumers? So look, we've got a great lineup. To give you some examples, we've got Vera Wang herself is going to be one of our keynotes. We've got CEO of Hugo Boss, there's C-suites from LVMH and Kering and Hermès, CEO of Chalhoub Group, so a local, the big local operator. And as we said, Steve, delighted that you'll be joining us as well. It's going to be really interesting 3 days, 27th to 29th of January. And we've also got a discount code that we'll make sure you can share the details for. So make sure you help your listeners with a bit of a discount for that too.
Yeah, that's right. We've got, thank you, very generous on your behalf, offering us a discount for our listeners. We'll put that in the show notes so folks can think and consider and get themselves over. You guys have just done such an amazing job for a new conference of bringing together the top tier in the luxury space. So congratulations on that. All right, let's talk about what were the buzziest, most remarkable stories of the week. Steve, why don't you go first? What were you thinking about? What caught your attention this week?
Well, I kind of alluded to this generally. To me, both Microsoft and Amazon announced that they will be doubling their already sizable data center footprint in the next 2 years. And again, it's just mind-boggling the amount of money that is going in basically to support the AI revolution. So, either this is going to be one of the dumbest bets in the history of the universe, or some of these really smart companies think this AI thing could be big.
Ben, what caught your attention?
So one of the things that really stood out to me was when looking through the CPG results we're talking about in the first part, there is one of the major CPG stands out in that it is actually driving volume. So it's the amount it's selling is increasing much faster than the venue value increase is putting through. And that's done on. So you're just under 5%, so 4.8% like for like, solid set of numbers, well ahead of peer group. But I think what has it caught my eye is because is the how it's done that. And it's done that because he's really heavily lent into understanding the behavioral and nutritional needs of consumers who are on GLP-1. And this is really driving the results. In North America in particular, they kind of basically pinned their growth in North America on the sustained momentum they're having in high protein products. Oh. So they're in a tailwind category, rather than confectionery is a headwind category for GLP-1. But they've absolutely lent in. And I think what's the read through? We're still at the early days of understanding the impact. It's still a relatively niche and relatively small things, but there's lots of talk that GLP-1, the prices are continuing to come down, and we've seen use Costco example. There is developments that is going to move from an injection to a tablet, and that's a massive barrier. Once that happens, and that's in development. But we worked with Kantar to bring some new research to our grocery shop show that we just done, and we actually did a panel that featured Kantar, and it also featured the CMO of Danone. And I think one of the things that they found is that the Kantar research, if you go onto GLP-1, and there's a very high number of people that drop out for various reasons, especially cost. But if you get on and stay on, what it leads to is it leads to consumers questioning almost every element of their food shopping behavior. Mm-hmm. And one of the results is they found that of the people that get on and stay on, 46% of shoppers changed their grocery main shop retailer.
Wow. Wow.
Yeah, that's huge. If you've worked in grocery or worked with grocery retailers, changing main shop is a really difficult thing to do because it's so ingrained, it's so habitual. So 46% is massive, and I think we're only just starting to understand the impacts of GLP-1 on how people shop and eat.
Interesting, super interesting. I had no idea about that stat about changing grocers. I was thinking about conceptualizing as thinking brands and brand change. From my perspective, the best show in retail in Canada ended its extended run last week as Ontario Supreme Court denied Chinese billionaire come department store revolutionary Ruby Liu the chance to buy 25 HBC leases. Unveiled in all these things was the fact that if she got the lease, the landlords were apoplectic. They did not want her to have these leases. Hudson's Bay, they wanted to get a little bit of pocket change and sell them to her. It turns out if they would have done this, and one of the big shopping malls would have had to give them a 175-year lease with a very sketchy business plan, to say the least. So anyway, it's been holding up some big real estate in Canada for a long time when Hudson's Bay left in top-tier malls like Sherway. So now that's very exciting. 2026 is we'll see what happens with all that real estate. All right, now let's turn our minds to what's on our radar screen for the weeks ahead. Steve, kick us off. What are you looking at?
Well, I'll be very quick here. It's really the same story that I had last week, which is the ongoing impact of the government shutdown. Standard caveat, things moving quickly. Perhaps something will have changed positively here by the time people are listening to this, but it doesn't look that way as we record this. But the big thing this week is that 42 million Americans will not get food assistance. Now, some people have been shocked that that number is so high. I think that really, you can get into the politics of that, I suppose. But it speaks to the reality
SNAP
that
program, right?
That's
despite
the SNAP
being
program,
SNAP program, where they get
or food stamps, people will call it. But but it speaks to the reality of despite the U.S. being a very wealthy country overall, there's a tremendous number of people that are living from paycheck to paycheck or in poverty. So it's a big program that looks like it will be cut off. So aside from the human impact of that, which obviously could be quite extreme, is another thing in combination with the medical costs going up a lot that could put an extra squeeze on spending as we go into the holiday season. So we shall see what happens with that, but that's a big story.
Actually, I'm in Amsterdam for a few days this week coming, talking AI and agentic commerce to a digital commerce community group, which will be a lot of fun. And then next week, we're having a visitor. So really looking forward to Steve joining us in London for a few days, organising a few little treats for you, Steve, when you're with us. But I think one of the things I want to do is spend a bit of time with Steve, and I think it's something that really should be on a much wider radar, is what's happening in the department store sector here in the UK. And why do I say that? You guys have talked a lot about department stores in the US, the headwinds, the challenges, the soap opera that is taking place across that sector at times. But I think what's super interesting is here in the UK, there's a bit of a department store revival taking place from the big two players, both in terms of their performance and their relevancy. So big two are Marks & Spencer's and John Lewis partnership. Marks & Spencer's famous, the bellwether of the high street, made a whole series of strategic wrong turns in the 90s, really suffered, at which point John Lewis kind of took over that mantle as the bellwether for the UK high street. And has more recently run into some headwinds. And it would have been very easy to write both off as globally structurally the department store sector is not right and is not fit for purpose and is not relevant. But they're both going through a fantastic turnaround. Marks and Spencer's is further down. It's probably better known as well under Stuart Maitland's leadership. The merchandising proposition in both general merchandise and in food is unrecognizable to where it was a decade ago. And Steve, I think we should go and visit the latest concept store, and you can kind of see and experience some of that for yourself. But more recently, and this is under Jason Tarry. So Jason Tarry, great retailer, formerly ran the UK business at Tesco. He's now running the John Lewis partnership. And under his leadership, it looks like they've turned a corner. And there's some really interesting things that's starting to happen there as they drive their relevancy. It's only, you can see it in store. You can't quite see it in the numbers yet. Whereas in M&S, the sales line's flying. So, look, I think there's a whole episode on what's happening here and read-throughs for multi-brand retailers globally. But, looking forward to going into a couple of these stores, Steve, in the West End and getting your reflections on them next week in London.
Just a quick question on that. Do you feel like, because I think we see throughout the Middle East, in Asia, to a bit on the continent, in Paris, some department stores that I think really are quite spectacular, but it seems like my impression is they tend to be in the major cities, which have a very different kind of real estate situation than, say, if you look at the US and Canada, where, yes, of course, you have some of those stores, but for the most part, you've got kind of the suburban sprawl kind of story. Do you feel like that renaissance is occurring just, outside of the high street and just, London to the rest of the chain?
Yeah, no, great question. I think there's two dynamics. Number one is across the world, particularly outside the US, we're seeing really great progress in high-end and luxury and premium department stores. I think what's particularly interesting about what's going on in the UK with Marks and Spencer's and John Lewis is they're not luxury. Okay, they both command a slightly more premium price point, especially in their food offer, but they are mass market retailers. So I think that's one difference, and I think that's one where there is a really interesting read-through to your consumer proposition in a John Lewis really isn't any different to a Target, for example, or shouldn't be.
Or Macy's.
In theory. Yeah, or a Macy's. Exactly. And I mentioned Target because it's really interesting. When we go and see how both Marks and Spencer's and John Lewis have invested in their food proposition and their fresh food, and how that drives the traffic in a way that Walmart has driven traffic, in a way it's improved this fresh food, and you compare that to where Target has got stuck in its grocery proposition, that I think is really interesting as traffic drivers. I think the second element is around the location. I absolutely think that the in city centre and strength of high street is absolutely helping European department stores. So you will see, whether it's London, I'm in Amsterdam next week, the European large city centres are as busy, as vibrant as they always have been. There is no lasting significant post-COVID drop in terms of footfall. It is as hard to squeeze yourself onto an underground train on a Tuesday, Wednesday, or Thursday in London as it was back in 2019, 2018. So I think the volume of people in the city centres and the foot-based traffic is absolutely helping versus the challenges that mall retailers are having in the States, and particularly look, I know you talked about it before, A malls. Fantastic, doing really well, but the challenge of getting traffic into a B mall is slightly different. Now, does that play out across the whole of the UK? Not consistently. So I think for A malls and B malls, read major cities and smaller provincial towns. Some of the small provincial towns, so smaller provincial cities are struggling, and the oxygen is being sucked by the larger metropolitan areas. But there is definitely a helpful dynamic of city centre versus kind of spread and mall-based retailing.
All right. Well, Steve, I'll be looking forward to hearing your perspectives once we get you back on the mic, once you're back in the States from your visit, about all these things and your visit. All right. So this has been a fantastic episode. It's been our privilege, and thank you, Ben, for joining us. I'll be seeing you in Vegas. So look forward to seeing you in Vegas, baby, for the 10th anniversary of Shoptalk. Steve, you'll be seeing him very, very soon. And then again in Abu Dhabi. That's a wrap on this episode.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.